Guys, you are welcome to the platform. Share as you join, you share as you join, you share. It's 10:30 and we are going to start. I'm going to start with a word of prayer. Father, Lord, I thank you. I bless you. I glorify your name. I thank you for giving us the opportunity to come to share your word today and to enlighten people on this very important subject that we are going to talk about. It's about empowering your people financially, empowering your people, making them be able to take advantage of the market in which they are. So information is king, and we know you empower us with information so we can share on our different platforms. Father, this is the way we know what we know, we're giving it to the public. And we also expect that what they know, they can share it so that all of us can benefit and live a better life. Father, I thank you for your inspiration. I thank you for your word. I thank you for being present in our lives. I thank you for the blessings you keep giving us. In Jesus' mighty name we've prayed. Amen, amen, and amen. Like I said, I'm going to do something that's a little bit different from what I normally do. I normally would tell you what I'm going to talk about, and then we end up doing exactly that. But today there's something different. Today, the original plan was for me to talk about the inflationary market, was to talk about how inflation is impacting our taxes, what's happening to inflation, and how the IRS has adjusted its numbers to take into consideration the inflationary market. I think the platform that I needed to be on a particular platform to provide that particular teaching to us today. And I was, for some reason, my technology did not allow me to be able to give that particular subject. My technology was not giving me the information in the way that I wanted to see it. And so I decided that instead of giving information in a way that people are not going to fully be able to take advantage of, it's better. We maybe defer it to next week, and then we can provide that information in a better way. So today I'm going to talk about something that's on very, very much in the news, very, very much out there, something that everybody needs. We are going to talk about some key tips to help you plan for the tax season. The tax season is very, very much, the tax filing season is starting on the 1st of January of 2023. And before we get there are key things that we must do to make sure that our tax season is the best tax season possibly that we can get. That we are optimizing on what we are paying to the IRS. That we are making sure that we're not giving any extra dollar to the IRS. And we are making sure we're taking advantage of all the tax incentives that are out there. And I thought this is the time to really tell people. I have told you this several times. If you don't plan your taxes before the tax season ends, before the tax planning season ends. And remember, the tax planning season ends when? It ends on December 31, whatever year it is. So for this year, it's going to end on December 31 of 2022. And after that December 31 of 2022, you get into tax filing season. Nobody wants to get into the tax filing season without having prepared for during the tax planning season. When you get into the tax filing season, it becomes what the Frenchman calls a fait accompli, which means you have to file what you got. But at this time, you still have the possibility to make certain tweaks to your taxes so that you don't pay excessive taxes, or so that you meet the strategic objectives of your business when the time comes. Remember, there are two strategic goals when you are in business, or wherever you are, when you are in life in this America, or wherever you are. The first thing when you're doing a business, you have to think about, how do I optimize my profits? How do I make the maximum profit? That's the incentive. That's the intention of every person who gets into a profit-for-profit business. But if you are in a non-profit business, the intent is, how do I maximize the services that I am out to provide to the people? How am I going to meet my overall goals for this season? Your goals could be profit making. Your goals could be providing a service to the community. Your goal could be being able to acquire the additional capital that you need to, in order to acquire the wealth, to acquire certain business tools that you need in order to grow your business, or even build certain things that you want to do for your personal wealth building project, for your personal wealth building objectives. So today we're going to tell you on those key tips that you need as you plan your taxes. Number one, I think we'll just dive straight into it, and we'll tell you in a way that it's undiluted, in a way that you can actually go and implement it immediately. And for those of you out there who are my clients in one way or the other, it is time for you to contact me. If I have not contacted you as a client, you want to contact my office immediately to make sure that we are keeping you, we are helping you to be in the best position as you get into the tax season. Nobody wants to be surprised in terms of how much they have to pay in taxes. But regardless of how much you have to pay in taxes now or tomorrow, once we are able to assess what your tax bill is going to be based on projected revenue, projected income, we can already tell you certain things to do immediately to kind of reduce that tax bill by a significant amount. And we're going to talk about that today. So the first thing I've always told people is that you have to structure your business. For those of you who are running a business and you're making money, if that business, if you think that the structure of that business is not yet optimal, you want to talk to our company. You want to call our company. Tell us so that we can tell you what is the best structure for you to optimize your tax position. And I see this out of a lot of experience. I do a lot of we do a lot of tax resolution. And tax resolution is about helping people who have problems, who have letters from the IRS, who have issues with the IRS, to help those resolve in the best way possible so that they can avoid paying the mammoth amount of taxes that has been maybe billed to them by the IRS. That is what we do. So basically, structure is always going to be key. I tell people, when you start business, you have to just go start there and start making money. But once you start making money, you have to restructure. Some people are better off being as informal businesses. Those are businesses that have not been registered and things like that. But in most cases, you want to structure and then register your business, and then choose a particular form of business, a particular type of business that will help you optimize, be in a best tax position. I need to put this computer on charger because it's saying something. Just give me 1 minute. One quick minute and I'll be back with you. The charger is not on for some reason. Oh, jeez. Yes, I'm here. Yes. Yes. I wish I was in the office. I would have had some support for that. Great. Perfect. So, we're back. So, we were talking about tax structure, and we said structuring your business is always going to be number one thing. And when I say this, I can give you examples. If you are structured as an informal business and you're making money, you are going to pay something called, it's called you're paying FICA, you're paying what they called, oh geez. So you're going to pay self-employment taxes, and self-employment taxes amount to 15.3%. So if you made 100,000, before you even calculate your normal taxes on those 100,000, you're going to pay an additional $15,300 on that 100,000, just because you are not structured properly. So if you're structured as an S corp, you can avoid that. You're structured as a corporation, you can avoid that. So please, that is number one. Structure correctly. If you are not structured correctly, call our office. We are going to help you do that before the year ends, so that you are properly structured to be able, because it's not only about changing the capital, the structure of the business and making it formal. It's more about understanding what your intents are and what you want to do so that you can maximize on that. But secondly, it's also about being able, not only structuring, but being able to take advantage. There are other things around the structure that are important for you to do before you can qualify for that structure that you're taking. So it's not just changing the structure, you have to qualify to change to that structure. And we can help you structure that. Number two, which is very important, is working capital management. Most of you are getting at that point in the year. You're getting to that point in the year where you have to organize your working capital. You have to make it in a way that, when I talk about working capital, let me just be explicit. Working capital is about your cash flow. It's about your current assets. It's about your accounts receivable. It's about your accounts payable. It's about current assets, which are anything that you can very quickly convert into cash, such as accounts receivables, the billings that you've sent out and things like that. Those are all parts of your working capital. Your inventory. You have to be able to manage your inventory in a way that you meet your objectives for the tax year end, so that when you get into that, let me give you an example. For example, you have current assets. You have your current, you have your accounts receivable at a certain number, and then you have your accounts payable. If you pay a lot, for those of you, most of those clients who are small businesses, you are on cash basis. On cash basis, what it means is that you have to be able to understand when to pay your creditors, when to pay your debts, when to pay money out of the business, and you have to also understand where to buy new assets into the business. For example, if you are in a stage where you are going to make a lot of profit, I tell clients, if you are going to make a lot of profit and your overall objective is to reduce your tax bill, because there could also be an objective where you want to buy machinery or buy some important tools for your business. And if that way you are in and you want to have that credit that allows you to buy those things, then your objective you have to revisit your objectives, because if you reduce your income, then you are reducing the amount of capital you can access in order to buy some of those equipment. Maybe you want to buy a car for the business. Maybe you want to buy another truck for the business. Maybe you want to buy something and you know that, or you might want to buy a commercial property out there. There are certain levels of income that you must be at in order to access what you need. And in those cases, your objective might be a little bit tweaked. You may have to talk to me. You may have to talk to somebody, and especially before the year ends, so that we are able to make it happen. So if you are at that point where your whole objective is to reduce your taxes, and you don't want to buy assets, you don't want to acquire assets to be able to make some of those things happen, what you're going to do is you are going to, because you're making so much profit, you are going to buy more of your inventory. Try to stockpile. Buy more inventory that you will need for your business. Because when you buy, you're actually spending money. And you're spending money, you're reducing your tax base. You're reducing your taxable income. And by reducing your taxable income, you're reducing your tax. But again, we have to talk about how much you want to do in terms of that. Remember, the more you pay out, if you're on a cash basis, if you pay a lot, if you buy certain things, a lot of stock, if you stockpile during the December month, then it will reduce your taxable income and then it will make you pay less in taxes. So working capital management is so important. But if on the contrary, you wanted to buy an asset, you wanted to buy something important, and then you think, hey, I want to leave my income. I've seen people come to me and they say, oh, for some reason, they want to improve they want their income to be higher because they want to acquire something. They want to buy that home. They want to buy something. And if your objective is that, then you want to reduce your stockpiling, because stockpiling simply means that you're buying more. You buy less so that you have more money. You have more business, more overall income for your business. So those are very critical things that you want to think about. Then there is also that, so that's very important. Working capital management is very, very key. There's a lot of things you can do about your working capital to try to improve your tax position, or also to maximize your capital position, your credit position, in order to access credit to buy, to improve your business. Number three, and this is very important, you can also manage your tax bracket. Managing your tax bracket will fall among some of the things that I've already said. So if you estimated your taxes and you are on a 20% tax bracket, or 22%, there's no 20% tax bracket, I'm sorry. You are on a 22% tax bracket, for example. What you basically want to do is, you can think of those things that you can do to maybe increase, to move from that higher tax bracket and come to the lower tax bracket. And those things are things like, I never tell people, I've seen a lot of people tell me, no, I don't want to make more money, because if I make more money, I'm going to pay more taxes. I mean, I look at that as being, we are in business to make money. We are in business to grow our asset base. We are in business to grow. I cannot tell anybody, I cannot tell any business person, don't make money because you are going to do this. I tell people that go there, make the money, and then we can play on how you structure your expenses, how you structure some of your, how you structure your expenses in order to be able to, when I talk of expenses, I mean to structure your tax deductions, because there are so many things you can do to reduce, to go from that tax bracket, which is a 22% or maybe 27% or maybe 32% or maybe even 37% tax bracket. There are so many things you can do to move from that tax bracket to a lower tax bracket and still maintain your business growing, still be getting that amount of income you need to get. So working capital management, not working capital management, I'm sorry, managing your tax bracket is something you have to do. And doing that, you don't just do that. You don't just do that without knowing. You need to know what your tax estimate is. That is why estimated taxes must be done at this point in time. There is something called tax planning. Tax planning is a separate business, and you don't just think that maybe your CPA or your accountant will do your tax planning for you. It's a whole process, and generally they will reach out to you and tell you that, okay, we have to do this. Please go for tax planning. Tax planning is so important. It makes you know exactly how much you have to pay, and it makes you have the ability to avoid paying. Maybe your estimated tax was saying that you were going to pay maybe $100,000 in taxes. Just by doing 1, 2, 3 things, you can break that tax in half, or you can even take that tax to zero. I can tell you how you can take that tax to zero just by acquiring one thing, just by doing one thing before the year end. So it's important that tax planning be done. And for all my clients, I'm reaching out to you individually so that we can talk on your project, where you are. I see where you are for those that we do bookkeeping for. I see where you are, and we are already working with some of you, and all of you, we're going to work with you to make sure that you avoid taxes in the most legal way, without evading taxes and without reducing your activity, without reducing your income level. That is very important. The next thing I want to talk about is number 4. We've already talked about 3. Number 4 is deferring incomes. Very important. So many people will ask me, what do you mean by deferring incomes? What do you mean by deferring incomes? Deferring income simply means that I'm telling you that some of the money that you make, you can avoid taxes on them above the line. You can't avoid taxing them now, and they could become taxable maybe 20 years down the line, maybe 15 years down the line, maybe in the future. That is what you call deferring taxes. And the reason most people take this advantage is because you are at that stage where maybe your tax bracket is that high tax bracket. You're paying a lot of taxes now because you're making a lot. You're at that peak of your activity when you're making a lot of money. And so the idea is, I want to defer part of this income so that I take advantage of it. I own that. I take that money at later stages when maybe my income will not be as high, my income will be lower, or maybe the tax structure would have been more favorable for me. But I don't have the cash right now to be paying taxes on this. And one of the key things, one of the key benefits you get, one of the key things that the government has provided you in order to defer your taxes is when you put money into your retirement buckets. When you defer taxes through retirement, for maybe you're putting money into your 401k, you're putting money into Roth IRAs, you're putting money, if you have business, you have self-employment plans, you have set plans. If you are putting money there, every money that you put in there, as long as you meet the thresholds that were required by the IRS, by the government, those monies that you put in there are not going to be taxable now. Let me give you an example. All your 401k money that are being matched by your employer, or if you are a solo proprietor or things like that, all your 401k money are tax deferred. They are called tax deferred money. So what does that mean? That simply means that you are not going to pay money on them. So if you put $5,000, that $5,000 is going to reduce your taxable income. If you put $10,000, that $10,000 is going to reduce your taxable income today. It's only going to be taxable for 401ks, for all the Roth IRAs. It's going to be taxable after you get to 59 and a half years. That's important, because when you get older, you are not as effective as you were, and you're now waiting for retirement. You can use that money and your tax brackets will be a lot lower. And one thing I wanted to tell you is, for Roth IRAs, those of you who are taking any of these plans, those plans have to be set before the December 31. They must be set before December 31. They must, again, be set before December 31. I repeat, any plans that you want to take, you want to put money in. You cannot decide to do that when you come to prepare your taxes and your tax person or your accountant or your CPA tells you that, oh, your tax is this amount, and then you say, can I take this? You cannot take that anymore. A set plan, for example, for 2022, I'm sorry. The set plan for 2022, the IRS just released their structure, and you can save up to $66,000 in there. So if you made $100,000 in profit, in business income or in income, you can basically, or in business, not in income, in general taxable income, you can put up to $66,000 of that money in a set plan and not pay a dime on taxes on it. So you made $100,000, you put $66,000 in your set plan. So you're just paying taxes on what? $34,000. Let me tell you, if you saved $66,000 and you are, let's say you were in the 22% tax bracket, you just saved yourself from paying IRS $14,250. That is insane. So why are we not doing this? The IRS is simply telling you, put money in your retirement and then I'll give you a pass on your taxes. We should all be doing that. You're just keeping money for yourself. You're saving money for yourself. And remember, and I've said this before, I said that when you have money in these plans, 401k, Roth IRA, traditional IRA, set plans, all these monies, they are being put there and then they are given to some financial advisor or a financial firm. They basically do the investment of that money for you, and then you get returns on that money based on those investments. However, the good news, what many people don't know, what many of us don't know, and I'm going to tell you, and I've said it before, is that many of us, everybody, each one of us, you can basically self-invest that money. You can decide that, oh, instead of me having that money in that bucket where these guys are doing it, I want to take that money and put it into real estate so that when the market crashes, I have it into tangible real assets. And those assets are building money for me. Over the next 20 years before I get to retirement, that money would have built significant amount of money for me. So you can self-invest money that you have in all these plans. This is very important. And I think many of us should be doing that. We should take that money and invest in a lot of things. Most of the time they take this money and invest it into stock market, or maybe they take it and even put it into virtual money. We have seen what happened to what recently happened to virtual money, to people who invested into in blockchains and things like that. They are going through a very tough time now because it has really plummeted to a very, very bad level. So if your money is sitting there, they are going to show you that your money is almost completely lost. Or you put your money and then it goes into whatever. They will show you that. But if you took that money and invested it in maybe real estate, into some real assets, then you are going to get the value, the benefits of at least the growth of that money. And you can, I say this out of experience. I know this works. So deferring incomes and then using the proceeds of that for a permanent investment is a huge market for us. We should take advantage of it. And again, I want to repeat, you can only defer this income. You can only create these plans before the end of the year. You are not required to put money in there before the end of the year. You can put the money on the last day you're filing, but create the plan before December 31. And if you don't know how to do it, talk to us. We work in that area. We'll be able to help you do it. The next one we wanted to talk about is reinvesting in the business to take advantage of certain write-offs. This is a huge one. When you make money and then you reinvest in the business, reinvestment in businesses, you have to reinvest it properly. You have to restructure the reinvestment in order that, for example, you made $100,000 and you know for a fact that this business you're running, you need a property for that business. You have been paying significant rents for that business. Why not buy a property for that business? Why not buy your office location? Why not buy a commercial property? If you think that way, you can do it now. If you can close on that property, if you can close on a property before the year end, my gosh, there is so much you can do. You can basically leverage. You can take advantage of bonus depreciation. You can take advantage of segregation of assets. You can segregate those assets and then put them into different buckets that are taxable that are depreciable at different rates, because the property as itself is going to depreciate over, if it's a commercial property, it's going to be depreciated over 27 and a half, is it 31 and a half years. But that's a long time for you to depreciate it. The IRS tells you can take a bonus, you can take accelerated depreciation. You can depreciate accelerated depreciation, but you can also do cost segregation on that property. And then most of those items, like the cabinets, the fridges, the things, all those items, you will depreciate them over 3 years, over 2 years, over 1 year. Some of them will be, you don't have to, and most of those things, they are going to give you a huge loss. And those losses can be carried for years. Not only are they going to give you a huge loss, but you are going to create a good asset base that will help with the future depreciation of the asset. And what does that do? It only reduces or maybe make you pay no taxes over many, many years. That's an area we've been talking about. I can talk about for a day, for a year, for 2 days, and I help people a lot in that area. Another thing is debt financing. You can use debt financing as much as you can. What is debt financing? Debt financing simply means that when you use other people's money, you don't pay taxes on it. And that is what most people do. Most of the rich people, they don't take income. What you're being taxed on is on earned income. When you make income, when you generate income, when you make money, when you earn an income, it's taxable. If you don't earn an income, you don't pay any tax. Many people will ask me, how do you live if you don't make income? You are building wealth through net assets. Net assets, income is just a very small part of your net assets. Your net assets in a property could be growing significantly, but you're not taking any money out. And we can tell you how that works. And then when you have good net assets, what it does is that it allows you to be able to access what? To be able to access other people's money. Most millionaires, most billionaires, they don't pay taxes because they use other people's money. How do they live? They live on debt. If I have net assets worth $1 million or even $200,000, and then I need $20,000 to live, the bank is always willing to borrow me money because they know they are going to get their money back. And I will go to the bank and say, oh, I own all these assets, but I don't have cash. Can you put cash at my disposal? The bank will be like, yes, we are going to put the cash at your disposal. And when they put the cash at your disposal, then now you have cash to be able to to run with, but you don't have any earnings. So you don't have earnings, your asset base is increasing in millions of dollars, but you are living large, but you're living on other people's money, and then you're not paying any taxes. Debt does not pay taxes. Debt does not pay taxes. What pays taxes is income, is earnings. When you earn money, you pay taxes. When you sell a property, you have generated a taxable event because there is income that is generated. And if there is a capital gain on those proceeds, then you're going to pay taxes on those capital gains. But as long as you don't sell any shares, you don't sell your stock, you don't sell your property, you don't sell any of these, you are living on maybe debt, or maybe you're living on debt that you took from the banks. You don't have any taxes to pay. There are no taxes. You don't pay no taxes. So this is so important, guys. This is very important. This is where the big boys play. They play on this. If you can play on this, you avoid taxes. Manage capital when you dispose of assets. We can talk about that all year. Real estate investment. Real estate investment is one of the biggest areas. Real estate investment is one of the biggest areas of what? Of tax avoidance. One of the biggest areas where the government gives you all sorts of incentives, all sorts of prerogatives, where you don't pay no taxes. Real estate investment. If you are investing in real estate, maybe commercial real estate, maybe rental real estate. I'm not saying that you buy your own home. Many people buy their homes and they come and see me. How does that impact my taxes? It's going to increase. It's going to affect the basis of that property when you sell it. So whatever you do, whether you're improving your home or things like that, they will help in the sense that when you sell that property, if you had maybe refurbished or you had remodeled your home, that will increase the basis in that home. But it's not going to affect your taxes now, unless that property, part of it is being used for business purposes. So real estate investment is an area where we could talk for days, and we have a lot of videos on real estate investment and how they affect your taxes. Billionaires don't pay taxes. They don't pay taxes because they invest their money in real estate. Millionaires don't pay taxes because they invest their money in real estate. And if you invest money in real estate, there are thousands of ways that you can avoid taxes. And we can talk about that all day long. I have videos on that, and I'll be talking on that more, because one of my biggest projects right now, I am actually building some online material for people, and this is going to be privy to those who are part of my network, of my community. They are going to be able to go in there and learn how to be a real estate professional and how it affects your taxes, how you can live tax-free forever, how you can transfer generational wealth to the next generation for tax-free, because that is where people lose a lot of money. I think we have come to the end of this. There's a lot of things we can talk about, but I just thought we should talk about these things today. We should tell people about how they can build generation, how they can build wealth, how they can tax plan, how they can plan their taxes. And forgive me if I didn't talk about this restructuring that has been done within the IRS to maybe modify tax tax numbers. We are going to talk about that in our subsequent editions. I think what is more important is for each and every one of us to be able to structure our taxes. Each and every one of us needs to know what we need to do in order to pay the least in taxes. I want to thank you. I want to bless you. And I want to wish you the best for the coming week, the coming month. And I wish that what we're saying here is not just falling on deaf ears, that you are able to take this and take advantage of it. Use it for your taxes. Use it so that you can save that extra income and then invest it in those things that mean a lot to you, and build that wealth that you want to transfer to your next generation in a tax-free manner. Thank you. Thank you. Thank you. You have an excellent rest of your day. Bye-bye.